Imagine a world, right, where you could send money online to anyone, anywhere, and you wouldn't need a bank or PayPal or, any of those financial middlemen.
Just directly, person to person.
Exactly. It sounds a bit like sci-fi for digital payments, but that's the core vision we're diving into today.
We're looking at the source, the foundational document.
Yeah, Bitcoin, a peer-to-peer electronic cash system. Published way back in 2008 by the very mysterious Satoshi Nakamoto.
Still mysterious today.
Totally. So our mission here in this deep dive is really to pull out the most important nuggets from this paper. We'll look at the problems Satoshi saw with, traditional online payments.
And then the really clever, almost radical solutions proposed, this idea of electronic cash.
Right. The goal is that by the end, you'll have a really clear grasp of the fundamentals, those core concepts that underpin this whole revolutionary system. Hopefully, you'll get those aha moments that cut through the noise.
Let's do it.
Okay, so let's unpack this. The paper, it kicks off by pointing out something we barely think about in online shopping.
Our reliance on these middlemen.
Exactly. Financial institutions as trusted third parties, we just take it for granted, don't we? We use a credit card, PayPal, whatever, and there's a company handling it.
But Satoshi saw issues there. The paper jumps right into the inherent weaknesses of that model.
Like what specifically?
Well, think about it. Completely non-reversible transactions. They aren't really possible in that system.
Because the middleman can always step in, mediate disputes.
Precisely. And that mediation, while sometimes useful, has hidden costs. The paper argues it bumps up transaction costs.
So that makes tiny payments maybe not worth it.
Exactly. It limits the minimum practical size. Those small, casual online transactions, suddenly they're kind of economically unfeasible.
Right.
And it goes deeper. You can't truly make a final, non-reversible payment for, say, a digital service you've already received.
Right. And merchants, they have to be constantly worried about fraud.
Yeah, asking for more info, more personal details, and even then, a certain amount of fraud is just accepted. It's unavoidable in that model.
Physical cash avoids that if you're face-to-face.
Right. But digitally, over a network, before this paper, there wasn't really a way to do it securely without that trusted party.
Okay, so if trust is the weakness, what's the alternative Satoshi laid out?
The paper is really direct here. It says we need an electronic payment system based on cryptographic proof instead of trust.
Cryptographic proof. So math instead of a middleman.
Basically, yeah. The goal is simple. Allow any two willing parties to transact directly, peer-to-peer.
And the key is making those transactions. What was the phrase?
Computationally impractical to reverse.
Right. That's a huge shift. It protects sellers from fraud, but without needing a bank's approval or intervention.
And the way to achieve that, the solution to the big double spending problem, is this peer-to-peer distributed timestamp server.
Okay, timestamp server, how does that work?
It generates computational proof, like undeniable evidence of the chronological order of transactions. Everyone can see it. Everyone can verify it.
And the security doesn't come from one central place being trustworthy.
No, not at all. It comes from the combined computing power of the honest participants. It's the network itself that secures the network. A totally different way of thinking.
So let's get into the coin itself. The paper defines an electronic coin. How?
In a very specific way. It's a chain of digital signatures.
Digital signatures,
Yeah.
like a unique, unforgeable stamp.
Kind of, yeah. Each owner transfers the coin to the next by digitally signing, using their secret private key, a hash.
A hash being like a digital fingerprint of data.
Exactly. A hash of the previous transaction plus the public key, the receiving address of the next owner, and this signature gets added to the coin's history.
So you can trace the ownership, verify the chain.
Yes, verifying ownership is one part. But then comes the really tricky bit Satoshi had to solve, double spending.
Right. How does the person receiving the coin know the sender didn't also send that exact same coin to someone else just moments before?
That's the million-dollar question, digitally speaking. Before Bitcoin, the usual fix was, well, another middleman.
A trusted central authority, a mint.
Yeah, something like that. A central database checking every single transaction. But as the paper points out, that just puts you back in the same boat.
The whole system depends on that one company, like a bank.
Exactly. So Satoshi needed a way around that central point of failure.
And the solution was?
Radical for the time. All transactions must be publicly announced, broadcast to everyone.
Okay, public announcement. But how does everyone agree on the order if two conflicting transactions appear at roughly the same time?
That's the second key part. You need a system for everyone, all the participants, to agree on a single shared history, the order in which transactions were really received.
So the pay needs proof. Proof that the network agrees their transaction came first.
Precisely. Proof that the majority agreed, not just one central entity.
Okay, so how do you get that public, agreed-upon history without a central coordinator?
It starts with this concept of a timestamp server. Imagine taking a hash, that digital fingerprint again, of a whole block of new transactions. And then you publish that hash widely, like metaphorically, putting it in a newspaper or a public online forum.
To prove that data existed at that specific time.
Exactly. And here's the clever bit. Each new timestamp hash includes the hash of the previous timestamp.
Ah, so it creates a chain.
Yes, an unbroken chain where each new link reinforces all the ones before it. Tampering with an old one would mean redoing everything after it.
But how do you do that in a distributed way, without one central server doing the timestamping?
That's where proof of work comes in. It's like a computational puzzle or lottery.
Okay.
Nodes on the network basically guess numbers, running them through a hash function like SHA-256, until one of them finds a hash result that starts with a specific number of 0 bits.
Finding a needle in a haystack, essentially.
Pretty much. The difficulty, how many zeros you need, can be adjusted. Finding it takes a lot of trial and error, a lot of CPU work. But checking if someone found it, that's super easy. Just one hash calculation.
Hard to find, easy to verify.
Exactly. And once that CPU effort is spent to find the proof of work for a block, you can't change anything in that block or any block before it without redoing all that work, plus the work for all the blocks that came after.
That sounds incredibly difficult. That's the immutability.
That's the core of it. It makes the history incredibly hard to tamper with.
And this proof of work, it also solves the voting problem. How the network agrees.
Yes, really elegantly. Instead of trying something like one IP address, one vote, which is easy to cheat.
Someone could just get loads of IP addresses.
Right. Satoshi proposed one CPU, one vote. Your influence is proportional to your processing power.
So the majority decision, the true history, is represented by the longest chain.
Yes, because the longest chain is the one that has had the most proof of work, the most computational effort invested in it. It's objective.
So as long as most of the computing power is honest.
The honest chain will grow faster. It will outpace any attacker trying to build an alternative fraudulent chain.
An attacker would have to redo the work for a past block and all the blocks after it.
And then catch up to and overtake the honest chain's ongoing work, which gets harder and harder.
The paper says the probability drops exponentially.
Exponentially, yes. With every new block added by the honest network, the attacker's chances of catching up plummet.
And the difficulty adjusts to keep block creation steady.
Yeah, there's a target, like an average number of blocks per hour. If blocks are found too quickly, the difficulty automatically increases. If too slowly, it decreases. It keeps the pace consistent.
That's like a self-regulating system. Okay, so let's walk through the network in action. How does a transaction actually get confirmed? The paper lists steps, right?
Yep, 6 key steps that are constantly happening.
1, new transactions get broadcast out to nodes.
To all nodes, or at least many nodes.
2, each node collects these new transactions into a candidate block.
Bundles them up.
3, each node starts working, trying to find that difficult proof of work for its block.
That's the mining process, the digital lottery.
4, when a node gets lucky, finds the proof of work.
It broadcasts that completed block to everyone else.
5, other nodes receive it, check it. They only accept it if all the transactions inside are valid and, crucially, not already spent.
Right. They verify everything. No invalid blocks allowed.
And 6, they accept the block by what?
By immediately starting to work on the next block, using the hash of the block they just accepted as the link, the previous hash.
So they build upon the valid block.
Exactly. That's how the chain grows.
And nodes always assume the longest chain is the right one.
Always. That's the rule. They keep working to extend the longest valid chain they know about.
What if 2 nodes find a block at almost the same time? Create a fork.
It happens. Nodes will typically work on the first one they received, but they keep the other one just in case.
Okay.
The tie gets broken pretty quickly, usually within 1 or 2 blocks when one branch gets longer. As soon as that happens, all the nodes switch to the longer chain. The shorter fork gets abandoned.
So the network converges on one history. It seems really robust.
It is. Transactions don't need to reach every single node immediately. As long as they reach a good number, they'll get into a block eventually.
And missed blocks aren't fatal.
Nope. If a node misses block 100 but then receives block 101, it'll realize it's missing something and just ask its peers for block 100. It catches up. It's designed to handle temporary disconnects and message drops.
Okay, this sounds incredibly clever, incredibly robust, but it needs people, nodes, running software, using electricity, doing that proof of work.
A lot of electricity, potentially.
So why? What's the incentive? Why would anyone bother running a node and mining?
The incentive structure. It's key. The paper introduces a really important rule, a convention.
Which is?
The very first transaction in every new block is special. It's called the Coinbase transaction.
Okay.
This transaction creates brand new coins out of thin air, and those coins are awarded to the node, the miner, who successfully found the proof of work for that block.
The block reward.
Exactly. It serves two critical functions. One, it's the direct financial incentive to mine to secure the network.
And two.
It's how new coins are initially distributed into the ecosystem. Since there's no central bank just printing money, this is the mechanism.
Satoshi compared it to gold mining, right?
Yeah.
Expending resources to get new gold.
Precisely. Expending CPU time and electricity to mint new bitcoins.
So that's the block reward. Are there other incentives?
Yes, transaction fees.
How those work?
If you send a transaction, you can optionally include a fee. Technically, it's when the output value of your transaction is slightly less than the input value.
The leftover bit.
Yeah, that difference, that leftover amount, is the transaction fee. And the miner who includes your transaction in their block gets to collect that fee on top of the block reward.
So miners are incentivized to include transactions with fees.
Right. And the paper even looks ahead, suggesting that as the block reward gradually diminishes over time, which it's designed to do.
Halving every few years.
Yeah. Eventually, the incentive system could transition entirely to rely on these transaction fees alone, making the system potentially completely inflation-free in the long run once all coins are mined.
That's interesting. There's also this idea about an incentive to stay honest.
Right. It's a game theory point. Even if a greedy attacker somehow got control of more than 50% of the network's CPU power.
Which would be incredibly hard and expensive.
Extremely. But even if they did, the paper argues it's actually more profitable for them to just play by the rules, collect the block rewards and fees honestly rather than trying to attack the network.
Why?
Because attacking the network, like trying to double spend, would likely undermine confidence in the entire system, crashing the value of the very coins they're trying to steal or control.
So their own self-interest keeps them honest.
Potentially, yes. It's a fascinating economic argument built into the protocol.
Okay, beyond the core mechanics, the paper touches on practical things too. Like, won't the blockchain get huge? All those transactions building up forever? Disk space.
Good question. The paper anticipated this. It explains that once a transaction is buried deep enough under many subsequent blocks.
Meaning it's extremely unlikely to be reversed.
Right. Then, the details of older, spent transactions before it can actually be discarded to save space. You don't need to keep every single detail forever.
How does that work without breaking the chain?
It uses something called a Merkle tree. It's a way to hash all the transactions in a block together, layer by layer, until you get a single hash for the whole set, the Merkle root.
And only that root hash goes in the block header.
Exactly. So later on, you can prune away the older transaction data, keeping only the headers and the Merkle roots. This proves the transactions were there without needing to store them all indefinitely.
So you can compact old blocks.
Yes. The paper estimated a block header without transactions is only about 80 bytes. With blocks every 10 minutes, that's roughly 4.2 megabytes per year.
Which, even back in 2008.
Yeah, with computers having maybe 2 gigs of RAM, the paper concluded storage probably wouldn't be a major bottleneck. Though obviously, it has grown significantly since then.
Okay. What about verifying payments? Do you have to run a full node, download the whole blockchain, just to check if someone paid you?
No, and that's important for usability. The paper describes simplified payment verification, or SPV.
SPV, what's that?
It allows you to verify payments without running a full node. You basically just need the block headers of the longest chain, which is much smaller than the full blocks.
Okay, just the header.
And you need the specific Merkle branch, the path through that Merkle tree, that connects your transaction to the Merkle root in its block header.
So you're not checking everything yourself?
No, but you're linking your transaction to a specific block in the longest proof of work chain. You're seeing that the network, the majority computational power, accepted it.
But is it as secure as running a full node?
Not quite. The paper acknowledges it's more vulnerable if an attacker did manage to overpower the network. They could potentially fool an SPV client with a fake transaction on a fraudulent chain.
So for businesses getting lots of payments.
They'd probably still want to run their own full node for maximum independent security. SPV is more for lighter use cases.
Makes sense. Let's talk privacy. Traditional banking, for all its flaws, offers some privacy, right? Only you, the other party, and the bank know the details.
Or limited access.
But here, all transactions are public. Everyone can see the blockchain. So where's the privacy?
It comes from anonymity, essentially. The paper explains that privacy is maintained by keeping the public keys the addresses anonymous.
So the public ledger shows that address A sent X amount to address B.
Exactly. But it doesn't show who owns address A or address B in the real world. There's no inherent link to your identity.
Satoshi compared it to stock market trades.
Yeah, like the tape showing trade sizes and times, but not the names of the buyers and sellers. It's pseudonymous, not fully anonymous.
Then to improve that.
The paper suggests using a brand new key pair, a new address for every single transaction you receive.
To avoid linking different payments back to the same owner.
Right, and acts as an additional firewall. Though it also notes that multi-input transactions, where you combine funds from several addresses to make one payment, inevitably reveal that those input addresses belong to the same owner.
So some linking is unavoidable.
Some is, yeah. It's a trade-off.
Okay, let's circle back to security one last time.
Mm-hmm.
The paper really digs into the math behind defending against attackers, right? Specifically, someone trying to double spend.
Yes, there's a whole section calculating the probabilities, and it makes a really crucial point first.
Which is?
Even if an attacker somehow manages to create a longer alternative chain.
Which is the goal for a double spend attempt.
Right. Even if they succeed, it doesn't mean they can just do anything. They can't create coins out of thin air. They can't steal money that never belonged to them in the first place.
Why not?
Because honest nodes on the network will simply reject any blocks containing invalid transactions according to the protocol rules. The attacker's power is limited.
So what can they try to do?
Their main goal is to change one of their own past transactions. Specifically, to take back money they recently spent by creating an alternative history where that spending transaction never happened or happened differently.
Double spending their own coins.
Exactly. That's the primary attack the math addresses.
And how does the math characterize this race between the honest chain and the attacker's chain?
It's modeled as a binomial random walk, which is related to the gambler's ruin problem in probability.
Okay. Sounds complex. What's the takeaway?
The key takeaway is about the probabilities. Let's say P is the chance an honest node finds the next block, and Q is the chance the attacker finds it. If the honest nodes have more power, so PQ...
Which they should if the network is mostly honest.
Right. Then the probability of the attacker ever catching up, especially if they fall behind by even a few blocks, Z's blocks behind, drops off extremely quickly, exponentially fast.
So the deeper a transaction is buried in the blockchain,
the exponentially harder it becomes for anyone to ever reverse it.
The paper gives actual numbers for this.
It does. For instance, if an attacker has, say, 10% of the network's computing power, so Q0.1.
Which is still quite a lot.
Yeah. The chance they could successfully double spend a transaction drops below 0.1% after just 5 blocks have been built on top of it.
Only 5 blocks. Wow.
And if the attacker is stronger, say 30% of the power, Q0.3, you'd need about 24 blocks for that same level of security, less than 0.1% chance.
Still achievable.
And even if they controlled nearly half, like 45%, Q0.45, which is almost the nightmare scenario, you'd need maybe 340 blocks to get that same tiny probability of them succeeding.
So the math strongly suggests that transactions become practically irreversible very quickly.
That's the conclusion, based on probability.
Okay, so wrapping this up, the paper concludes by restating its core idea, right?
Yes, summarizing the proposal.
Yeah.
An electronic transaction system that fundamentally does not rely on trust.
Instead, it uses digital signatures for ownership.
Combined with a peer-to-peer network using proof of work.
To create that public, verifiable, computationally difficult-to-change history of transactions.
Exactly. As long as honest nodes control the majority of CPU power, the system is secure against attackers trying to change that history.
And the network's strength comes from its simplicity. Its unstructured simplicity.
That's the phrase used. Nodes work largely independently, with minimal coordination. They don't need identities. Messages are sent on a best effort basis, yet consensus emerges.
Nodes can leave, they can rejoin whenever. They just trust the longest chain.
They accept the longest proof of work chain as the valid history up to that point. It's self-correcting.
They vote with their CPU power.
Right. Accepting valid blocks by building on them, rejecting invalid blocks by ignoring them. It's an incredibly elegant way to enforce rules and incentives without a central authority.
So the final provocative thought here. This paper describes replacing trust in institutions with computational proof and economic incentives.
A fundamental shift.
What does that imply? Could we use this model, this way of thinking, for other things in our lives that currently rely heavily on intermediaries or central authorities? Think about data, identity, maybe even voting systems. What else could be decentralized using these principles?